If your goal is to be a better investor and avoid common mistakes, then remembering the examples in this video will be really important. I'm going to review some very surprising benefits of dollar cost averaging, and some may even defy your expectations. Then I'll close by sharing 5 important tips to help you be a much better investor as you put dollar cost averaging to work. So let's get right in. Follow me to the big screen. Okay, so here we are at the big screen, and we're looking at 3 different investment scenarios. Each one of these scenarios, we're investing $480 per month over 12 periods, so an entire year, because we'll just think about it as doing that every month. And each one of these investments is going to start out at a value of $30 per share. Now, as we think about these kinds of investments, we want to think of a broad index like the S&P 500 that we want to invest into. We're not looking at individual stocks when we're talking about dollar cost averaging, because individual stocks are really kind of risky anyway. An individual company can go down or up for lots of different reasons. We want to think of the broad index like the S&P 500. And remember that even professionally managed mutual funds really don't do all that great when compared against their S&P 500 benchmarks. Because as I've pointed out and looked at in previous videos, over a long period of time, like 15 years or greater, over 90% of professionally managed mutual funds underperform their S&P 500 benchmarks. So if professionals can't beat the market or beat the S&P 500, why should you think you can? Okay, so let's take a look at these graphs. Again, which one of these do you think would be the best investment? Notice this one just goes up all the time. That looks great. This one starts up and then kind of goes down, doesn't really look that good. This one here just does nothing but go down and stumble around here at the bottom for a while. Okay, so let's kind of zoom in and take a closer look at this one. So here's the first graph. We're going to start at $30 per share, and at $480 per month, you get to buy 16 shares. Then it goes up to $32 a share. Okay, not bad. We get to buy 15 shares at that price. Stays there for a bit, and then it jumps up to $40 per share. We're feeling pretty happy. We get to buy 12 shares. Stays there a bit, and then it jumps all the way up to $48 a share. Now we're really feeling happy, but we only get to buy 10 shares. Stays there a bit, and then jumps all the way up to $60 a share. Twice where we started. Okay, so we're feeling great. We only get to buy 8 shares though, and it stays there a bit. Okay, so not bad. If we add up all these numbers here, it totals 136 shares that we've purchased, and they are worth $60 a share. So what we have at the end is $8,160. Now, the next graph, it starts out at $30 also, so we get to buy 16 shares, jumps up right away. $40, we're feeling good, we get to buy 12 shares. Now it drops back down to 30, so we're kind of back to where we started. And then it drops again, all the way down to 20. But notice at $20 a share, we get to buy 24 shares. Stays there a bit, drops again to 15. Now, how many of you honestly would probably stop right here and think, well, I better just wait. The market's going down. I'm tired of losing money. I might as well wait till maybe it starts coming back up. Some of you might even sell. But notice at 15, you get to buy 32 shares. Stays there a bit. Jumps back up to $20 a share. We get to buy 24 shares. Stays there. Goes back up to $20 or $24 a share. And all the way back up to then to $30 a share. So it finally finished where we started. So we bought 272 shares, and they're worth $30 a piece. What do you know? We end up with the exact same amount. This graph was just as good as the first one. Now let's take a look at that last one. Remember, the last one really looked bad. Again, we start at $30 a share. We get to buy 16. Then it drops down to 24. We get to buy 20 then. Then it drops down again to 16. We get to buy 36 shares. Stays there a bit, and then it drops down to 15. We get to buy 32 shares. Then it drops again, all the way down to $12 a share. Okay? People would start panicking, wonder if they should sell and get out. Okay? But notice you get to buy 40 shares. Then it goes back up, stays there a bit, goes back up again. drops back down again, goes back up again. But notice, nobody feels very good through this period. Then it goes back up to $24 a share. Still less than where we started. It never even got back to where we started. But notice, we were buying through a really low period, kind of when the market was on sale. So all these shares, they total up to be 344 shares. You're only worth $24. And yet, it's actually the best investment. It's a little bit more than those other two. Okay, so now let's take a look at all three graphs again. Remember this graph, it looked great. This one caused fear. This one caused probably more fear and panic. And all of these, remember, they all started out at $30 a share. We were investing $480 per month. Total invested, therefore, was $5,760. Now, remember this one here, the value at the end was $8,160. And which means we had a gain of $2,400, which doesn't sound surprising, I guess, because this one just did great things. It doubled in value over that 12-month period, okay? We buy for a little bit, it goes up. We buy and it goes up, okay? Everybody's happy. This one here, though, remember, it was just as good, okay? Even though it went up and then caused a lot of fear and panic as it went back down. Okay? We would have had to stay invested through this whole period of time and just keep investing every single month. And this investment was just as good as that one. And what about this one? It was actually the best one of all three. It ended up with $8,256, not a lot more, but who would have thought that this investment was better than this one? Okay, so we got to be very careful when we look at graphs like this and think that we can decide what would be the better investment. This is why dollar cost averaging is such a huge advantage to an individual investor. Okay, you don't have to know anything. It takes the fear and panic out of things. It takes all the emotion out of things. You just buy and invest the same amount every single month, whether it's the market's up or down. And what we want to remember is that when the market is down, you're buying it when it's on sale. Now, let's take a look at some actual periods that actually happened in the market. This is October of 1987. I want to highlight this because it's the single biggest one-day drop ever in the market. In one day alone, the S&P 500 fell 20.5%. What a lot of fear and panic that caused, okay? But notice the market recovered. This is the housing crisis of 2008. Actually, it started in October of 2007, ended in March of 2009. Over that period of time, the S&P 500 fell 56.8%. Holy cow, again, that caused a lot of fear and panic. Again, but notice the market recovered. In fact, it recovered all of its losses by March of 2013. How about the spring of 2020? Again, a huge drop that happened rapidly. Over 4 weeks, just 4 weeks, the S&P 500 fell 34%. However, that year, from January to the end of December, even though this occurred, the S&P 500 actually increased 18%, including the dividends it pays. So it was a wonderful year, and people were panicking about this. So let's zoom out so we're not like zoomed in on what's happening right now. Here's 1987. Here's that worst day ever in history. It's a little blip. It's completely insignificant. Here's 2008. Sure, it went down, but it recovered. Okay? The market, the S&P 500 over long periods of time, like 15 years or longer, has always averaged around a 10% compounded annual growth rate. So you know it's going to do okay over a long period of time. Remember those earlier graphs we looked at? These bad times are really your best times. These are when, instead of feeling fear and panic, you should realize it's giving you an opportunity for somebody that does dollar cost averaging to buy when the market is on sale for a while, and it helps you over the long term. Here's 2020. That huge dip that occurred in a 4-week period, it recovered right away. Here's 2022. The market was down around 18% that year, but notice it's back up. Again, those are wonderful opportunities for somebody that does dollar cost averaging. Instead of feeling fear and panic, You should just be happy that you're getting an opportunity when the market is on sale. Okay, now after reviewing the insights presented by those graphs, let's review some important concepts that we all need to keep in mind. First and foremost, it's important to understand that investing is more of a long-term endeavor. Thus, what the market does in any given year should be completely irrelevant to us. Over the past decade, ending in 2022, the S&P 500 has returned a compounded annual growth rate of 12.6%, which is great. However, that's only for those who remained invested throughout the entire period. Even if we factor in the financial crisis of 2008 and examine the 20-year period ending in 2022, the S&P 500 still had a compounded annual growth rate of 9.8%. Again, this is only true for those that didn't panic and sell during stressful times. These averages only reflect the performance of investors who navigated and remained fully invested during both the good and challenging times. By the way, if you like the sound of those returns, you may want to explore my video on investing in the S&P 500. I'll provide a link in the description below. So our goal is to never engage in panic selling. I know it can be gut-wrenching to see your investment portfolio take a sudden dive. The urge to stop the bleeding can be overwhelming. However, selling with the assumption that you'll time your re-entry point once the dust settles is among the most detrimental actions an investor can take. Selling during a falling market ensures you lock in losses. And historically, market trends show that recoveries can restore portfolios to profitability within just a few years or much less. What we should do instead is recall those earlier graphs. Our reference point lies in the market performance over extended periods of 10, 15, and 20 years, which is an average of around 10% compounded annual growth rate for the S&P 500. Armed with this knowledge, we should embrace market downturns and perhaps even view them as golden opportunities. It's important to understand your own risk tolerance, and I'll provide a link to a video in the description below to maybe help you do that. Before we jump to the 5 helpful tips, I hope you hit the like button and consider subscribing to the channel if you haven't already. And don't forget to leave your comments below. Now, here are 5 important tips to keep in mind. Number 1, dismiss the notion of trying to time the market. That's a fool's game that leads to losses. Hiding out in cash and trying to predict when the market might rebound is nearly impossible, and many of the best days occur shortly after hitting bottom. Missing even a few days can have a profound impact on your investments. Consider this illustration of how a $10,000 investment would have grown over the 40-year period ending in 2020. Missing just 10 of the best days in the market would have cut your earnings by 55%. And missing just the top 20 days would have slashed your earnings by around 74%. Remember, it's the duration of time spent in the market that matters, not attempting to time when to buy the market. Number 2, during market downturns, resist the urge to frequently check your accounts. That will only add to your stress. Remind yourself to adopt a longer-term view and understand that these periods are normal and potentially great opportunities. Number 3, especially in times of market declines, filter out the news updates and so-called market experts. They often peddle fear and panic for the sake of ratings. Focus on your investment strategy rather than worrying about what pundits are saying. Number 4, remember that one reason 401k plans through your employer are so successful over time is due to the fact that they utilize dollar cost averaging. Contributions are made with every paycheck, regardless of market fluctuations. Number 5, dollar cost averaging is so simple and can benefit anyone. It involves investing a fixed dollar amount at regular intervals, regardless of share price or market trends. This approach helps build disciplined investing habits, enhancing investment efficiency, and reduces stress. You don't need a lot of money to get started either. Even if it's only $50 per month or $100 per month, just get started and stick to it. Make it a habit and the first thing that comes out of your budget every month. If you happen to have a larger sum of money and you're wondering how to invest it, you may want to check out my video comparing lump sum investing to dollar cost averaging. I'll provide a link to that in the description below also. But for most people, dollar cost averaging is such an effective strategy that can enable anyone to become a better investor. So remember that during market downturns, try to maintain a positive outlook and embrace dollar cost averaging. You'll be very happy you did. Thanks for watching.